Max and Peter, let's start with you and the impact of rising yields on stocks and bonds. Peter, first, break down those rate expectations for us. Is a June cut still on the table?
It's about 50-50. This morning when I checked, it was actually under 50. I think Bostic, who's a voting member, basically said, I don't want to cut until the end of the year. Waller followed that up. But putting aside what these Fed members are saying today, what's complicating their decision-making is the rise in commodity prices and the potential bottoming in goods price inflation. I mean, the CRB index yesterday, so before today's further move in commodity prices, closed at the highest level since August 2022. Gold is making record highs every day. What self-respecting central banker is going to blow off the commodity price move and the rise in gold and say, yeah, let's just cut rates anyway? So they're actually being stuck in a corner by markets and the economy and this commodity inflation that's going to make their decision-making even more difficult.
Right. A lot of the discussion among Fed members has been around the risk of cutting versus the risk of not cutting. Max, what are you looking at in terms of equities? I think you're expecting 1 to 3 this year. Where are you leaning towards today?
Well, we've been saying that we think rates are going to stay higher longer. And if the Fed is going to make the cuts, it would be towards like the fourth quarter. And maybe 50 basis points is what they should be cutting if they are. We think inflation is still very stubborn in the market, and it's much different to go from 8-9% down to 3 or 4 than to 4 to 2. So we think the Fed has to stay the course a little bit longer and get rid of the inflation. But again, it's not if they cut interest rates, it's just when. The market's just reacting because it was overly optimistic, and it has been for a while, about the Fed cutting. They thought they were going to cut in March. They had all these big cuts scheduled for June, and they were looking 5 to 6 cuts this year. Now they're starting to put it off. So we think it's just what's happening against expectations. We just think everybody's just too optimistic on the Fed.
Right, and the market started the year pricing in a lot more of these rates cuts. Peter, one of the concerns has been if the Fed cuts, we could create more of a bubble in equities if you believe that there's already one there. Where does the risk in your mind lie? Cutting too soon or waiting too long?
I mean, that's a great question and the difficult needle to thread. I mean, the Fed created this monster of this addiction of financial markets on monetary policy. So it's not a coincidence that stocks bottomed in October 2022, just as the Fed was about to slow down the pace of their rate increases, because the market started to price in, okay, we're coming to the end of this rate hiking cycle. And now, of course, they got excited that not only are rates done going up, they're going to start going down, and the Fed may even start tapering QT. On the other hand, of course, the last thing that Powell wants to see is a reacceleration of inflation, because he got too cute, got too complacent, and started to cut interest rates too early. On the flip side, there's a lot of mixed signals in the U.S. economy. I mean, we have the jobs number on Friday. Well, going into that, the unemployment rate, even though it's historically low at 3.9%, that's still a 2-year high. And there's still a lot of pockets of weakness, in addition to some strength within the economy, that's causing, to me, at least from my perspective, the most confused I've ever been in analyzing the economy. So it's tough to say that there's one right answer here. I think the Fed is really just sort of in this hall of mirrors trying to figure things out. And then, of course, you have the election in November, which they don't want to be seen reacting so close to that election with respect to rate cuts.